For around 90 seconds until the bell, and we have full coverage for you. We have Tom Essaye, he's the founder and president of Sevens Report Research. Also, Jared Blickery will be joining us in just a few minutes from the floor of the New York Stock Exchange. We're taking a look at where things stand here with a minute to go, and we're seeing losses accelerate here into the close. The Dow, which was off only around 70 points at the start of the program, now off 140 points. We're seeing the losses there led by Caterpillar. Now that stock off just around 2%. Boeing and American Express rounding out the three worst performers in the Dow today. Let's take a look at the sector action because it's interesting here when we look at the mix that's at play. Financials, industrials, and materials among the worst performing sectors today. On the flip side, though, healthcare and utilities holding on to gains. We've also been talking about the meme action more recently. Some of those meme stocks really getting attention here from the Reddit traders, from Wall Street bet traders. Clean energy fuels was one of the names bucking the downward trend today. The stock up just around 20% heading into the close. And it's the second most talked about stock today on Wall Street bets. It's a top trending ticker here at Yahoo Finance. The 5-day gains of that stock just around 55%. But it's interesting when you take a look at the action that we're seeing in clean energy fuels, because it's very similar to what we've seen recently from GameStop, AMC, and Clover Health. But again, taking a look at the major averages, we are looking at losses across the board, but the Dow looks like going to close off just over 140 points.
And that's a wrap. With the gavel, we have a close, and let's see where these markets are going to finally settle. As Sean was just saying, accelerating to the downside as we head into the close. And the Dow will settle down about 152 points. The S&P 500 will end the day down about 7.6 points. NASDAQ's going to be off a little over 13 points. Some of the stocks we talked about earlier in the program, they're going to settle down today. Wendy's, we made a big deal about Wendy's, hit a new 52-week high yesterday, up a bit above $29 a share. It's going to close around $25, 21 cents a share. There's also UPS. They gave us their new outlook. They're going to start prioritizing their more lucrative packages as opposed to going after volume. UPS was down 4% today, closing at around $200 a share. Let's go back to our guest. Let's bring in Tom Essaye. And Tom, got to ask you real quick. We've got the 10-year. The yield is now below 1.5%. What is that signaling to you?
To me, it's signaling that the market is beginning to relax a little bit on inflation. Very early this morning, we got a Chinese CPI number that was under expectations. It's the first major inflation number in some months that hasn't come in at or above expectations. And I think that in a quiet market, investors viewed that as perhaps one of the first signs that we're seeing an easing of inflation pressures. More broadly, we have to remember the 10-year yield went from sub 1% to 1.74% in a very short amount of time. So really, if we step back, this is just a continuation of the consolidation of those gains.
Tom, do you expect the 10-year to stay around this level? Where do you think we're headed here, at least in the short term?
In the short term, we could easily see more weakness, perhaps down towards the 142 level or even lower, because again, this is a momentum-driven market, and we've obviously broken down support in the 10-year yield. Longer term, though, unless you think the economic recovery is going to stall or the Fed is going to suddenly get really hawkish, then if you're long stocks, you essentially have a bullish bet on the 10-year yield as well, because both are reflecting better growth ahead.
Stay right there. Jared is standing by on the floor of New York Stock Exchange, and you're going to give us a recap of what we've witnessed today. Jared?
Yeah, well, I'll just continue the conversation on bonds. I happen to have the 10-year T-note yield up on the Wi-Fi Interactive. I pointed this out an hour ago, but this level right here, 1.5 or just under it, that was bought, or at least the bonds were sold in order to raise the price of the bonds, the yield of the bonds, and we could very well do that. But given the action over the last 3 days, dropping this much, what's got to be about 12, 13 basis points, I agree with Tom. We could head lower, and that would be a tailwind for some of the growth stocks. That's when we had declining yields last year. For most of the year, that's when the big mega caps were doing very well. So here on the Wi-Fi Interactive, I just want to pull up a quick chart of the S&P 500. There's something called recency bias. It's easy to get sucked in and think that something big is happening when it's not, but the S&P 500 has gone nowhere for about 5 days or so. With a daily range today of about 30 basis points, that's when moves seem to be exaggerated. So you can see they're just really treading water over the last 5 days, mainly this week. Now we take a look inside the market. This is the NASDAQ 100. Those mega caps doing well today, as we would expect, except for Facebook. Facebook coming off of record high, that's down 1%. Just rounding out the discussion with sector action, healthcare, utilities, real estate, and tech, the outperformers today. So a little bit defensive here going forward.
Tom, we just heard Jared mention the fact that the S&P has been pretty range-bound recently. Is another catalyst needed in order to fuel the momentum to the upside, or what are you looking for in that perspective?
Yeah, I think so. I think really what we're seeing in the past 2 months, right, is the market, everything the market priced in has essentially happened, right? So COVID is effectively over here in the United States. We're not getting any more stimulus. The Fed is going to start tapering. So the market's investors sitting around saying, what's next? Well, the what's next is inflation temporary? And we're going to get a good insight into that tomorrow via CPI. And then more importantly, how is the Fed going to handle tapering? And are they going to mess it up? And we're going to find out a lot about that next week. So I think until we get more clarity on that, look, we're bumping around. We're right below the all-time highs. So by no means is this negative, but you're absolutely right, Shauna. This market is in need of a what's next.
Tom, I'm going to plug your report, Seven's report, because this discussion about inflation, there's what we all get, wages going up. We get that part. But you laid it out in this most recent report about the painter, trying to get a painter for your house. And you pointed out that the threat to earnings in 2022, perhaps, is the fact that if the painter can't get the people to paint the house, then the painter can't do the job and therefore doesn't get paid to do the job, which slows down productivity in this economy. How big a threat is this?
I think it's bigger than most people are admitting. And perhaps it's because I'm in the middle of a never-ending renovation and I'm experiencing this kind of in firsthand. But it's a real problem. I mean, being serious, in small business, employees equal productivity. If you can't get the people to do the work, you will make less money, period. And if you expand that out over many communities and over many months, that's a headwind on economic growth. Look, it's not a headwind for July or maybe even August, but late in 2021 and then early 2022, we need to get this labor market fixed, and we need to get people back to work. For whatever reason, they're not going back to work. That needs to change. Otherwise, it will become a headwind, and people are not anticipating that.
Tom, Essaye, always great to speak with you, founder and president of Seven's Report Research.